Hello and welcome on another episode of Kuvera Insights, where we talk to industry experts on what's going on in the investment world and how to prepare your investment so that you manage this phase well. Today, again, we have two very distinguished guests who have had a long history of investing or tracking investments in this country. First is Mr. Ambareesh Baliga. He's experienced in different facets of the markets for the last 35 years. So at least 7 business cycles. I've seen a lot of ups and downs. I've seen a lot of crashes and a lot of magnificent rallies. So we definitely look forward to learn a lot from him. He's worked at a lot of reputed firms, PwC, Kotak, Harvey, Way to Wealth are a few of them in segments such as wealth, fund management, corporate advisory, and retail finance. You would probably recognize him because he writes very regularly in Outlook Business and Business Standard, as well as he's seen on TV a lot on channels such as CNBC, CNBC Awaz, NDTV, ET Now, to name a few. We also have with us Vishal Chhabria, who's a senior associate editor with Business Standard, and he's been tracking the markets and the economy for 2 decades. Again, someone who has had a very good vantage point to see how our economy and how our markets have developed over the past 20 years. He's worked with Outlook Money, with DNA, and with Business Standard, amongst others. And he has had some of the biggest market moving interviews under his belt as the deputy editor of The Smart Investor. And he is passionate about swimming, snooker, reading, and technology. So welcome, Ambareesh, and welcome, Vishal. Pleasure to have you here, and thanks for taking the time to join us. So let's start with the only question that matters, right? In terms of if you're a stock investor, if you're a mutual fund investor, what is the impact of COVID on the earnings of India Inc? I mean, both short-term impact and long-term impact. And Ambareesh, do you think some of this is already priced in the stocks currently?
I mean, earnings for the first quarter of FY20 is anyways, it's a write-off. And I think the markets have discounted that to a large extent. But then when these earnings come out in black and white, possibly the markets can react a bit negatively. I mean, we may see some semblance of normalcy in quarter 2 and hopefully some green shoots in quarter 3. So I don't think any analysts are looking at FY21 numbers as such. I think most of them are now trying to project as to how the companies will perform in FY22.
Right.
This again is assuming that this pandemic peaks out by July, August, and we see the numbers coming down sharply by September, October. Then I suppose we could see a good growth in FY22, possibly taking us back to that 5.56% GDP which we saw last year.
Right.
But again, I think a number of business models may change. Work from home may become a norm for many. Demand for commercial spaces may taper off, whereas affordable residential space, especially on the fringes of the city, may see a rise in demand after a very long time. Again, something like a restaurant business may move more towards a cloud kitchen, as social distancing will make storefronts expensive, despite possibly lower rentals post-COVID. So whether the risks are fully priced in, I would probably say no. I mean, how the post-COVID situation will pan out is anybody's guess. Will we have a second wave? We don't know yet. If the numbers come down sharply, will people forget about the dangers and will the government loosen the curbs? I think all these are unknowns. So again, whether people will shop, dine and travel like what they did earlier, I mean, we assume they will not for a long time, but again, we can't be sure. So, taking a calculated guess, we can assume the worst is behind us. But frankly speaking, the future is still unknown.
Here in India, our headline indices are still probably 20 to 30% below their peaks, right?
Right.
So what gives? Is it just that they have access to more liquidity, which is kind of just driving this rally?
Answering your second part of the question first, I think our market rally has been driven basically by the way the global markets have panned out and that's in fact improved the sentiments out here to a very large extent. Because I mean, you look at the sentiment vis-a-vis what is actually happening at the ground level. I think there is a vast difference. I mean, it's a complete contrast of a scenario, because most of the entrepreneurs are still struggling, whereas here we are seeing I mean, decently good move in the markets. This again possibly could be because of a lot of liquidity which has flown in. I wouldn't say what has flown in from FIs, because they in fact have been withdrawing for a while, except for possibly the last 2-3 weeks we have seen some investment from them. But I think it's a lot of domestic liquidity. I mean, people have been sitting at home with nothing much to do. And if you look at the figures, close to about 12 lakh new accounts have been opened in the last 3 months. In fact, someone like Zerodha has gone on record saying that they have opened about 3 lakh new accounts. So clearly, I think a lot of this liquidity is flowing in. And there again, I would say it is more like freshers' luck that most of them would have made money because the markets have moved up. And generally, when you make money, you tend to put in more money into the markets, and that's exactly what is happening right now.
I mean, some of that is true.
Yeah.
I think some of that data definitely is true. I think Zerodha is on record, and I think a lot of investment platforms have said the same thing. We saw massive inflows in March. Even at an industry level, if we look at mutual funds also, right, the SIP book has been very steady. You would not have expected that given how volatility has risen. So I think some of that is happening. New entrants are coming into the market. I mean, beginner's luck. Uh, I would still give it 6 to 9 months to 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 actually comment on that. But that definitely is happening. Coming to you, Vishal, one of the big opportunities for India that everyone is talking about, right, is establishing India as an alternate manufacturing hub, right? So, how do you think about that? I mean, how real do you think that opportunity is, and how prepared do you think we are to actually capture that opportunity?
See, to be honest, I'm both optimistic as well as worried. Optimistic because there is a clear intention to get things moving and make India an attractive destination for global as well as local companies. If you see the big tax cuts which were announced last year, that is one measure to attract companies. Now, very recently, we've also seen how Reliance has been able to attract so much money into geo platforms and raised more than ₹1 trillion in a matter of weeks. Companies like Airtel, Bajaj, Kotak, Mahindra promoters, they've also raised a few $1 billion in this weak market and economic environment. So, in recent years, we have also seen the significant interest in areas like renewable power, especially solar. There's a clear visibility on how well Indian companies can do in sectors like pharma, chemicals, IT, and many others. So, on one side, there is clear sense that the foreign investors or companies do have faith in India that yes, here we have the required skill sets, we have capabilities where you can set up shop and do business from here. But there is also a sense that when it comes to execution or policy related issues, so we might be missing the wood for the trees. Now, take the example of solar power. After we started out well, we have recently seen some states try and go back on the power purchase contracts they signed earlier. So, such moves actually hit business confidence hard, and then it becomes difficult to regain and attract investors. Now, at the same time, you have smaller countries like Vietnam, etc., which have actually done well in terms of attracting global companies. So, all what we need to do is actually have a clear, stable set of policy as well as proper infrastructure, which will give confidence to foreign investors to actually come and set up, foreign companies to come and set up their businesses out here. And there is lots of potential in areas like you talk of food processing, you talk of defense. Our country also needs these kind of investments, and we have the ingredients to actually export for many of these uh, countries and companies.
So especially we have some advantage where consumption as well as manufacturing for export can be combined, and that makes a lot of
Yeah,
sense actually, because as a country ourselves, I mean, we are underfunded in many different sectors, right? I mean, infrastructure being one of that, but also defense and also food security, so on and so forth. So yeah, I completely agree. I mean, I think the opportunity is ours to lose. Um, we have to ensure, and I think this time it's probably the stakes are the highest than they have ever been. So we have to kind of ensure that we build the right incentives, and also we build them fast enough to be able to kind of capture this opportunity, which comes to the point. If you have to think about which sectors are best positioned to take advantage of these tailwinds, one of the sectors I think about a lot is pharma. For the last 3 years, there were headwinds, for valid reasons also. And now, of course, all of a sudden, pharma is center stage globally. Indian pharma has done the best. I think amongst all sectors, pharma mutual funds have performed the best, and pharma stocks have done the best. So, is this still a good time to think about investing in pharma stocks or mutual funds? And how should a new investor think about it? Should you go with a mutual fund? Should you go with specific stocks? And are these, is this tailwind sustainable?
Pharma sector was underperforming last so many years since I think 2016, and now this COVID-19 has become a catalyst of sort for the pharma space. And lately, in the last 2 months, that hydrochloroquine demand clearly turned the global attention to India.
Right.
However, the main benefit which I see for the pharma space is the softening of US FDA, which was on an overdrive in the last 3-4 years, putting a lot of pressure on the Indian pharma companies. But at the same time, I think this overdrive ensured that the Indian pharma majors moved up on the compliance scale. And now, thankfully, US FDA has climbed down. So, in fact, putting the Indian pharma sector in a very sweet spot, which now combined with the earnings upcycle, which you noticed in the last 2 quarters, along with new product launches, it seems that a fresh new rally is just beginning in this space. Although we have seen a decent move in the last 2 months, but I think this is just the beginning. Now the question is, I mean, how to play the sector? So generally, whenever there's a sectoral rally, I think it's better to play that via sectoral mutual fund than individual stocks, unless one really has a very good understanding of the specific stock which one wants to buy. Now, generally, when we talk of pharma, people also mix the hospital space along with that. I have a slightly different view on the hospital space now. It really cannot be bracketed with the pharma space, because I think they seem to be going through a really tough time because of COVID, because the cash cow, which is elective surgeries, has actually come to a major halt. And they've also been acting as COVID facilities for the government, for which they are not really getting payment on time. And in many cases, even the costs are not covered. We read in the newspapers about excessive billing by some hospitals, but that's only a very small percentage of the number of cases they're handling. And that really gets amplified, giving a feeling that hospitals are minting. But I think when we see the Q1 earnings for hospitals, I think that'll be a nasty surprise.
Will it be different this time as compared to earlier when we had seen companies actually do more of reverse engineering and play on the cost arbitrage? Or do you see companies actually moving up the value chain? And
yes, you may have a few of a handful of them possibly moving up the value chain. But then I think the majority of the companies which we have are actually more of reverse engineering. And now, thankfully, with that impetus for API manufacturing in India, which the government has laid out, I think that will be another booster for the pharma space, because at least the supply chain would be taken care of to a certain extent.
One of the other things that kind of we had also discussed about is the two of the other sectors that everyone talks about, right? Is banking and consumption?
I mean, banking, no doubt, was a favorite theme in the last few years. But again, here there's a dichotomy. Just like what I told you about the pharma and the hospital space. Here, in fact, the PSU banking space was seeking lower levels for quite a while. In fact, some of them are at lifetime lows. Whereas the top-notch private sector banks were performing extremely well, along with the newfound love for the NBFC space, especially the last 3-4 years, when they had taken the advantage of the vacuum created by the lethargy in the PSU banks. However, this COVID-19 proved to be undoing for those, especially NBFCs who are growing aggressively. And in fact, the markets were giving them that premium for aggression. But now that very aggression is the reason for the worry, as NPAs are expected at the individual and small business levels. I think the real trouble for these NBFCs will start when the moratorium ends. But when you look at the PSU banks, I don't think they will really deteriorate much more from here because it seems to be that they're provided for most of the bad loans, and slowly they have started also recovering. The NPAs which were there earlier. But clearly, I think NBFCs are at risk. Housing finance companies, though may see higher NPAs, would still continue to be safe. And still, I think the top-end private sector banks still seem to be the best bet. However, I think if you look at the RBI's latest draft discussion paper on the tenure of CEOs, if that is implemented, could in fact lead to change of guard for some of the private sector banks, especially, I would say, Kotak. So to sum it up, I would avoid possibly NBFCs. I would continue to hold the top private sector banks.
Right.
And possibly the PSU banks post-consolidations could in fact be the dark horses, because one should look for, and at the same time, I think one should look for opportunities in the small private sector banks, which could be target for acquisition. Now, coming to the consumption space, which we talked about, I think in addition to the shock of COVID-led shutdown and curbs on non-essentials, ensure that discretionary consumption comes to a halt. I mean, going back 3 years, post that 2 or 3 months of demonetization, we saw a surge in consumption. But post-COVID, I think would be a bit different. Unlike demonetization, now many people have been displaced. Number of people have lost their jobs, we had salary cuts, and still will have the fear of what the future holds for us. But India, with its 130 crore population, would continue to be a consumption-led economy. We should see a revival of discretionary spends, but I think they would be limited to the low-value items. I mean, for example, people may spend on a new iPhone, but they may not spend on a new iPhone, but may buy a washing machine costing about 20,000. Similarly, entry-level cars, two-wheelers may see demand reviving, as demand for personal transportation may increase vis-a-vis public transportation, because especially for those who can afford, would go in for this. Similarly, I think gold and jewelry may be low priority, except for wedding purchases. And even that is expected to be low-key, because again, for weddings, you'll not have too many people coming over. So as we move more towards normalcy, hopefully, we should see the consumption getting back on track. So this is again one theme where I will continue to be bullish, especially consumer staples and low-end discretionary. Whereas travel, tourism related, such as airlines, hotels, restaurants, movie exhibition, I think they would take a while to revive. And again,
these will continue on their upward trend as they have been, given the demographics and the age of our country. But luxury items will probably take a
absolutely
bit of time to come back on track.
Yeah, I mean, again, there I would say, when we're talking of super luxury, I don't think that will get affected too much. It is, I mean, something which falls between essential and luxury. Something which falls in between, I think, will get affected.
What can the government do more, right? I mean, the government's done a lot, or at least they have claimed to have done a lot. So, first of all, is that something, do you think that it was sufficient? The package they have put in place, is that sufficient? And what more could they could they do? What are the low lying, the low hanging fruits in your opinion?
What the government has done is, if you see from a market perspective, it's not enough. But given the kind of fiscal constraints, they have done at least to that extent what the people at the bottom of the pyramid are taken care of to a large extent. From here on, I think so. What they need to do is come up with measures which will actually instill confidence in the domestic economy, the people in the country, as well as those who are looking at alternatives to set up manufacturing facilities outside of China. With this, I think so they can get the economic engine back on track, although not 7-8% kind of growth rates, but at least a respectable 5-6% kind of levels we can come back to. And this they can possibly do at immediate way could be doing is by lowering the tax rates for the middle class and the rich, which will give them more money in the hands and give them also confidence in terms of spending power. Because now I'm quite certain many of the people are feeling low in terms of the cash they have on hand, given the impact on their income levels and the fear of job losses. So if this is taken care of, you could see a large part of the consumption economy coming back on track. At the same time, there are places where, like for example, the agri sector. Some of the measures were announced recently to open up the agri market, like allowing farmers to sell directly to third parties. That's a very good measure because, like, if X company, say Reliance or a Blue Star, can sell any of its products to anybody without any restriction, why should the farmer be restricted to sell his produce to only a select few? So that actually hurts trade, and that also impacts the income levels of the agri sector. So if you push in for more measures in this area, especially food processing, the uh, logistics chain, which actually allows you to get the farm produce from the farmland to the retail shops. So that can actually be another big revolution. Like in the past, we've seen a green revolution. This can actually change the face of rural India. And then there are sectors like defense. Now, anyway, we were actually importing a lot of equipments. Hardly a little was made over here. So now that they've increased the FDI limit in the or through the automatic route, that should actually help. Because if the same equipment is made over here, the steel which is being or the raw materials which are used to make that equipment, that will be most likely taken from the country itself. There will be labor which will be employed to manufacture that, and you'll also be saving a lot on the foreign exchange.
Fair enough.
Yeah, so if you move on these lines, you have stable, consistent, and very uh, what do you call clear policies where there is no way a state or anybody else with a change in political regime can go back. So those will actually give more confidence to the investors. Because if the policy changes are there, then you suddenly start thinking twice. Say, what's the point in investing in India if you don't know what the new government is going to come and do when you're putting in thousands and thousands of crores of rupees into the economy. Now the monsoon is expected to be normal this year, and everyone's hoping that rural incomes will be better, giving the higher MSP and the better monsoons. So at a time when urban growth is impacted and global economies are facing significant slowdown, which also reduces the scope for exports from India. So to what extent can rural India do the heavy lifting to revive or actually push in domestic growth?
clearly agriculture and rural India has been a decent part of the GDP. And now also, if we see that rural India, in fact, has emerged as a winner in this post-COVID scenario, because most of the green zones are in the rural belt. They were the first to be allowed to resume normal operations in April, as the harvesting had begun then. Again, if you look at the government stimulus, it was more focused on rural India. I mean, when it came to the SOPs, whether it was direct transfer benefits or increase in Manrega allocation, and like you rightly said, I mean, farmers have been allowed to now bypass APMC, which I think was a very bold move by the government. However, one needs to see as to how successfully they are able to implement that, since a large population of farmers are marginal and need to sell through middlemen. The reverse migration, again, I think will also help to a large extent to get more hands at the farm level. And now, with this normal monsoon, I think it will ensure that the consumption spike would be more predominant in the rural India than urban India. But again, like I said earlier, the demand boost would be more at the lower end of the discretionary goods. So overall, I think possibly rural India will increase its share in the overall GDP, at least for this year and possibly the next year.
So how will you play this theme now?
See, I mean, one can play this through the farm inputs. Again, it could be the tractor players. It could be, I mean, farm inputs like seeds and fertilizers, pesticides. And at the same time, it could be the FMCG companies, which are more focused on the rural side of the business. Vishal, I mean, one question for you is, see, I mean, markets seem to have run up due to global liquidity, like what we discussed, and improved, I mean, sentiments. But businesses are only slowly opening up now after close to 3 months of lockdown. I mean, what's the feedback you're getting from business owners, especially MSMEs, regarding the status at the ground level? And I mean, is the optimism in the markets reflected there? Because from my understanding, it is not. But since you're talking to so many more business owners, I would like to have your view.
See, to be honest, much of it is known to everybody, whether it is large, small, all companies are facing one issue or the other, like from getting their supply chains in order to working capital funds, logistics, or finding out ways to cut costs, and importantly, getting labor back. I think so. Labor is a bigger issue as many workers have actually gone home to their villages or hometowns. And with the cost of living in the hinterland low and some social benefits which the government has actually given, they may actually stay at home for some time. We all saw what kind of troubles the labor and migrants actually went through in the past few months. So it's difficult to say that labor will return anytime soon, at least until we have a vaccine or a treatment to actually take care of the virus, which is very necessary because it's a matter of life versus livelihood.
Right.
Yeah. And the quantum of problem actually, if you see, which is at hand, is also if you can see how companies are offering incentives to get back labor. It's actually a big swing in the if you compare the situation what it was a few months ago when unemployment was at a multi-decade high, and now there is shortage of labor.
Right.
So we are also not sure when the virus curve will start flattening and whether there will be a second or a third wave.
Hmm.
So and at the same time, if you see, there has been enough news on salary cuts. There's been job losses, bad loan problems for lenders, and slowing consumption. Recently, the MD and CEO of India's largest engineering and construction company said that he does not see significant private capex happening in the next 12 to 15 months at least. And governments also don't have enough money given that they have to spend on health related and welfare issues. So with all this, if you see, I'm sure the companies, small and large, all are not yet out of the woods. In fact, it will be some time before they will be close to normal levels. And in this context, I think the market may be celebrating a bit too early. The Among the few good things that is there for India Inc. is that oil prices are at pretty low levels, which actually helps keep the fiscal and trade balance uh, in some level. And interest rates are low, and obviously the demographic advantage is there. So how fast we can reignite demand will be a crucial part, apart from getting the virus under control from the market perspective.
Right.
Given the developments in the debt markets and the kind of muted returns in equities, how is it reflecting on the mutual fund investor in terms of is there a change in risk averseness, or are they changing portfolio allocations, or showing a preference for banking products?
Interesting question. So, see what's happened, at least on our platform, and at least from what the AMFI numbers that have come out. In terms of asset allocation, I don't think there has been a dramatic change. But I think within asset, especially within debt funds, specifically what has happened is that suddenly everyone has woken up and realized that, okay, credit funds take credit risk. Now, of course, most people should have known this, that that is true, but so that's something that we have definitely seen. So there has been an exodus from credit funds, but a lot of that money has then been recycled into liquid funds, to a certain extent ultra short funds. um, we do see some of that happening. In terms of, are we seeing a rotation out of equity into debt? On our platform, actually, what we have seen is actually the opposite. We've actually seen rotation from debt into equity. So there has been net equity buying. I think it's a bit difficult to say anything at the macro level, at an industry level, because industry level, what has happened in the past 3 months is that your SIP inflows have been north of 8,000 crores, so 8,600 crores, 8,200 crores, and so on and so forth. But net equity inflows have been somewhere around, 1 month was 11,000 crores, but I think last month was 5,000 crores. So effectively what is happening is, even though the SIP flow is net inflow, there has been net outflow. But then it becomes a bit murky to break down into whether it's been DII driven, or HNI driven, or ultra HNI driven, or institutionally driven, right? So some of that data cannot be very truly gleaned from what we have. What we do know is that the SIP books are constant, and at least the data that we are seeing, the rotation has been into equity. Um, we have had some instances of people chasing returns, but I think that's been mostly on international funds, to be very honest. I think the last 2 months have been, we have been recommending international funds since 2017, right? And we were always questioned on why international. And I think this is probably the last 2 months have been the only time when people have come and said, why not more allocation in international funds? So the risk, there was a risk aversion probably middle of March, when the markets really hit a low. And this is something that we can also glean from, like, Google searches. Emergency funds was something that no one ever talks about, honestly, right? I mean, we've been running this for 3 years, and we've been telling people you should have an emergency fund, but no one listens. And probably March, last 2 weeks, and first 2 weeks of April was the only time when people used to come and question, like, do I need an emergency fund? And if you look at the press, if you look at the media, there were more articles written on emergency fund in that time period than were written in the past 2 years, right? So um, there was a temporary flight to safety, I would say, but I think there has been a perceptible fear of missing out. So the rebound has been too sharp and too quick for a lot of people to even react. So I mean, I don't know if it actually clearly answers your question, but at least the two things that we can say confidently is credit risk funds definitely outflows on our platform and definitely even at the industry level. But mostly we are seeing rotation into equity and not out of it.
Okay. That explains what Amrish said earlier. There have been some pressures which have actually pushed up the stock market.
I mean, I wanted to at that point also say this, but have you guys been following what's happening with Hertz in the US? So Hertz is a car rental company, decades old company, offline car rental company.
Yeah.
They filed for bankruptcy, right? And the stock's going up ballistic because it's a penny stock, and apparently there's all these kids on Robinhood who don't understand what bankruptcy actually means. They just think it's a cheap stock, so they buy it.
Yeah. In fact, I think it's become multi-bagger in the last couple of days, isn't it? Yeah. Yeah.
It has. I mean, there are days when it was up 50% in a day.
Yeah.
And this goes back to and there's probably some kid there thinking, oh my God, I bought it for $100 and now it's worth 150. Investing is so easy.
I mean, there are a number of new players in the market, and I mean, even if you have seen the past booms, I mean, the boom is always made by new players. Like,
fair enough.
Yeah. I mean, I always like to say this, that generally the storyline is the same across. I mean, whichever boom and bust you see, the basic storyline is the same. Only the screenplay and the actors are different every time.
It's a very profound thought, actually. Human behavior does not change. What changes is whether it is tulips or South Sea or some island somewhere or some stocks, but the actual greed and the actual kind of the mania that drives prices is very universal. I would 100% agree to that. But on that note, I think fantastic to have you both here. A really good conversation. To kind of summarize it, there are opportunities for India Inc. Manufacturing can move to India. India also has the advantage of a consumption-led economy. So there are sectors where consumption plus exports can play a very good role in building out good companies. What remains to be seen is how the government and how corporate India deals with the after effects of COVID and what else lies in store. Once again, we have Ambareesh Baliga and Vishal Chhabria with us. Thank you so much, guys. It was wonderful talking with both of you.
Our pleasure.
Thank you. Our pleasure.